So hello, Finnomizers. Welcome to another Finnomize Live. My name's Russell, Global Analyst here at Finnomize, and I'm happy to host today's event on decoding market winners and losers with our partner, Charles Schwab. First, we have some housekeeping to run through. Please feel free to introduce yourself in the chat, and remember to switch to all attendees so everyone can see your messages. This is planned to be a 15-minute discussion, followed by a 15-minute audience Q&A. So please use the Q&A box to ask a question. And if you see a question you like, upvote it so it moves to the top. That way we can get through the most upvoted questions first. Okay, so let's get started. Today's session is brought to you in partnership with Charles Schwab. If you're not familiar with Charles Schwab, the firm believes in the power of investing to help individuals create a better tomorrow. It has a history of challenging the status quo, innovating in ways that benefit investors and the advisors and employees who serve them, and championing their clients' goals with passion and integrity. You can find out more in the link in the chat. Now, of course, no finance event is complete without a quick disclaimer. Your capital is at risk. This isn't financial advice, and the tax treatment depends on your individual circumstances and may be subject to change. With that out of the way, I'm really pleased to introduce today's guest. We're joined by not one, but two members of the Charles Schwab team, Kevin Gordon, Director and Senior Investment Strategist, and Richard Flynn, the Chief Executive of its UK retail business, Charles Schwab UK. Kevin is the Research Associate for Schwab's Chief Investment Strategist, Liz N. Saunders. In addition to analysing the US economy and stock market for Schwab's clients, he helps develop deep dive projects, as well as content for Schwab's public website, internal business partners, and social media outlets. Richard's an experienced financial professional with over 20 years' experience in equity markets, specializing in US investing and the delivery of financial advice. He's been with Charles Schwab for over 14 years, and for the last 6 years has served as the chief executive of its UK retail business, Charles Schwab UK. It's a real pleasure to have you both here today. How are you both doing?
Very good, Russell. It's a pleasure to be here.
Doing well. Thanks, Russell. Thanks, everybody.
So you'll see a poll on the screen. What's most important to you when choosing a firm for US investing? There's a rank from 1 to 6, with 1 being the most important and 6 being the least important. Please let us know what's most important to you. Okay, so let's dive in. First up, maybe Richard, you can take this first one. Why should investors use Charles Schwab to invest and trade in US stocks?
Wow, there's a number of answers to that one, but I think, in my experience, Russell, when we speak to people who are starting out or looking for help, guidance as to not just what to invest in, but which broker to choose, generally it comes down to some pretty fundamental basics. And the first one of those would be the research that's available. When people want to make decisions, they want to make those decisions in full knowledge of the facts around the companies or sectors or the market in general. And at Schwab, we have a remarkable breadth and depth of research that can help people with both idea generation and then further analysis of the investment choices that they look to make. So I think research is a really big part of it. Secondly, service is a really important part of it too. There are plenty of brokers out there that offer the ability to trade multiple markets. But you've got to think about what kind of service and support that you need and what kind of service is available. At Schwab, we have the ability to offer a 24-hour free phone support from everywhere in the world. So every country that you could possibly be tuning in from today, you'll be able to call up Schwab free phone and speak to a specialist registered representative, an experienced financial professional, a real person, not just a chatbot, but someone who's going to be able to assist you when you need that assistance. And lastly, cost. Schwab is and always has been focused on reducing costs for retail investors. That was really the origin of the business. Chuck Schwab set the company up in the 70s with the mission of making investing accessible to all, and that has led through scale to pushing pricing down so that now people have the ability to trade for $0 on equity trades with a $0 minimum and no account fees. And that makes a real difference to your overall return at the end of the day. So what I would summarize really for investors globally is looking at those 3 things, the research, the service and support that you get, and the low cost of being able to trade. They would be the big 3 for me if I'm telling people this is why you should use Schwab ahead of other brokerages.
Sounds like three very good reasons, yeah. Okay, maybe Kevin next up there. What do you think are some of the most important reasons to invest into the US?
So, I mean, there's a lot of innovation that's been driven by the U.S. Probably not a surprise to anybody who's been exposed to the market or watching U.S. stocks over the past several years. But I think one of the benefits, and this has sort of come into focus a lot because of the global trade war, and in particular what U.S. policy around trade has been. But if you look over the past couple of decades, the U.S. has really been more of a knowledge and an innovation and a service driven economy, and less, manufacturing driven, less goods based. We have become, a massive net importer of goods from around the world. And when you look at how much we're exporting in terms of that knowledge and innovation and that service, a lot of it, financial services based. I think, the benefit has accrued to the market, in particular, something like the S&P 500, which is the proxy for U.S. stocks. The weighting for a lot of the big sectors that house tech and tech related parts of the market, whether it's the tech sector, whether it's comm services, whether it's consumer discretionary, that has really grown to become a huge part of the market. There are some risks to that, which I can cover, later. But if you take the sort of positive spin or the optimistic outlook of that, there has been, pretty significant gains in multiple sectors. It's not just one, that rules them all. But I think the dominance of a lot of that services focus, and in particular of that tech trade and the growth stock mindset, if you want to think about it that way, that's really been, a really powerful force. And there have been feeder effects and ripple effects, from that. It's not just one area that benefits. And in particular, when I think about things like artificial intelligence and what that means for, not just the global economy, but the U.S. in particular, there's a lot of technology that benefits the rest of the market, the rest of the sectors that aren't necessarily thought of as the AI, creators. So if you want to think of them as the adopters, there's a lot of tech that we think, can benefit in the research that we've done that can benefit from what has been created over the past couple of years, or I should say, what's really been enhanced over the past couple of years. So it ultimately, continues to make the U.S., I think, for now, a relatively attractive piece of someone's portfolio.
Interesting there. Thanks for that. And you touched on AI, tech, adopters. What do you think are the best ways for investors to find winning stocks?
Yeah, so I think if you approach it from a sector standpoint, and I should, just to state at the outset, we're still neutral in terms of our recommendations on the 11 sectors for the United States. So everything from comm services to energy to healthcare, we just have what's known as a market perform rating, where we don't expect it to deviate from what the S&P 500 does over a longer term, 6 to 12-month basis. Which, not surprisingly, we implemented in early April, right after Liberation Day, just because the nature of what's been implemented and what continues to be implemented from a tariff standpoint, not even thinking about everything on the labor policy front, but everything that's been implemented so far, it's really put the sector analysis into a pretty tough spot. It's hard right now, given everything is still such a moving target. Eventually, it'll settle and we'll be able to reassume, the sector ratings. But for now, it's been a little bit more difficult to gauge who's going to benefit the most, who's going to get hit the most. Within that, I will say, if you take it down to the industry level, so there are, a couple dozen industries that make up the 11 sectors. We have found a stronger correlation in performance, probably not surprisingly, but stronger correlation in performance for industries that have higher profit margins, that have had, stronger profit margin growth, that have higher profit margins just in level terms. A lot of that, in our view, is driven by the fact that, when you talk about adding significant costs for U.S. companies, because as a reminder, when the U.S. implements tariffs, that's tariffs that are paid by U.S. companies because they're the ones that are importing the goods. When you impose higher costs on those companies, you have to be able to look for the industries or the companies that have higher margins and that can absorb that cost. So, again, probably not a surprise that they've been the best performers, but if you are sector or industry focused and you want to, invest that way, that's been a general sort of better way to, we think, to approach it. Our overall view and how we've been shifting how we invest and think about investing over the past several years has been more towards factors and characteristics. And that really just means, finding, and you can screen for this on Schwab's website. So finding companies or industries that have, high interest coverage ratios or strong profit margin growth or strong earnings or strong sales forecast. I mean, the list goes on, but anything that generally falls into that higher quality bucket, we've been in favor of that. That's where you found the most consistent outperformance of the past several years. And The real exclamation mark there is that you don't have to be beholden to just one sector or a handful of sectors. You can screen for strong profit margins and find that in all 11 sectors. So that's why we've found that to be a little bit more of a consistent and less volatile approach to investing rather than just looking at it from a sector standpoint.
So yeah, and just talking a little bit more about those screening tools, maybe Richard, you sort of want to talk about this. What type of tools are there that Charles Schwab offers for like people to find ideas?
Yeah, so idea generation is a really important part of investing, trying to find companies that meet your criteria. And, as Kevin said at the moment, companies that operate with healthy profit margins could be something to look for. How do you do that? Well, Schwab has a screening tool on its site, which allows you to choose the criteria that you want to implement. And, if you wanted to dig down from a sector level to an industry level to then a profit margin level, you can do that. You can say, okay, show me the companies that are operating at the profit margin of 15%, working within pharmaceuticals, for example, and you can then generate a list of companies that meet those criteria. You can then filter out by third-party ratings. So at Schwab, on the Schwab platform, we're able to offer up Argus ratings, S&P ratings. We have our own proprietary rating system, the Schwab Equity Rating, which has an A to F, very simple, like a college grade rating, with A being outperform and F being a sell. So what people are able to do through the Schwab platform is simply put in the criteria that are important to them. And that varies from investor to investor. Some people want a certain type of PE ratio, for example. Some people are very comfortable in particular sectors or looking at recent price performance to try and find entry points that are appealing to them. But what you're able to do, it's very difficult to make a decision if you're looking at a list of 100 companies. What you're able to do is use those screeners to whittle it down to something that's manageable, that you can then look deeper at those companies themselves and actually invest in the stock rather than just the company. And so you identify its recent performance, the criteria that I mentioned that make a difference to you. So the stock screening tool on the Schwab website is very effective. In addition to that, as Kevin said, looking beyond sectors or industries, we have a fantastic tool called Schwab Investing Themes, which has been launched internationally over the last year. And that's where it's some proprietary software that Schwab clients get the benefit of, which shows lists of companies that operate in certain themes. And an example of this, for example, if someone had said 10 years ago, you should consider microchips, as a particular companies that are making microchips, well, then the question would be, well, which companies are they? Where do I find that? Well, on the Schwab site now through Schwab Investing Themes, you can do that in a number of different themes which are of interest for people looking for something interesting in the next 10 years. So what is going to be the future of investing? Could be health food, could be AI, could be Chinese retail. How do I find the companies that are actually operating in these thematic areas? And the system that we built allows you to identify, once you pick out the themes that you like, and we have over 40 of those themes available, there's a list then of 25 companies operating in that area. And with one button, you can invest in all of those stocks, or you can cut out the ones that you don't like at a minimum of $250 to buy that basket of stocks operating in that thematic area. That's been really well received, particularly across our younger investors, people looking for diversification in areas that they feel will be investment themes of the future.
That's super interesting. That sounds a really good tool. Talk about innovation. By the way, people, listeners, please put your questions in the Q&A. We've got a couple more that I'm going to ask, but then if you put them in there, then, feel free to ask those questions and I'll get them across to Kevin and Richard. Okay. As you said, commissions and trading fees on Charles Schwab are zero. So investors can choose many stocks to build a portfolio. That thematic basket that you said is sort of super exciting. Yeah. So how many stocks do you recommend an investor could have, should have? Is there a minimum, a maximum? What do you think?
Yeah, look, the one thing I've observed about investing, Russell, is everyone is unique in terms of their approach to investing, the amount of time they have to spend, their own investing history, their views on risk, their views on money, what the actual investments are for. So fundamentally, you have to recognize that your own portfolio should be unique to you and your needs. Modern portfolio theory would dictate that really you shouldn't have more than 5% of your overall portfolio in any one holding. So by that, realistically, 20 plus would make sense. But, it very much depends on how much time you have to monitor and manage your portfolio. I always equate a portfolio to a garden. you have to occasionally clear out the weeds, and then you have to plant some new potential seedlings, and you have to monitor it quite carefully. And so, looking at it realistically, when I look at portfolios that have succeeded or investors that have shown a good track record at managing their money carefully, I've never really seen many portfolios with more than 40. So I'd say 20 to 40 holdings would be something sensible from a portfolio management point of view. But bear in mind, as I mentioned, everyone's individual. So it's whatever you consider to be appropriate to your management style.
Excellent. So 20 to 40 sounds like it's like a good number. And then finally, just before we move on to all your question answers, what do you think, maybe Kevin, are the biggest risks for investing in US stocks? And do you think they're different from investing in other countries?
I wonder
We
if we've
seem
lost Kevin. I
we may
can
have
try and
lost
field that
Kevin.
one.
So why do you
Yeah,
want to have a go at that, Richard? Yeah.
I'll have a crack at it. Just looking at it
Great,
from the
thank
UK.
you.
I mean, I'm here in London. A lot of our clients have a US portfolio alongside their UK portfolio or European holdings. As Kevin mentioned earlier, I think the US has a history of innovation. The breadth of choice in the US is far more significant than any other capital market in the world. There are over 12,000 listed companies in America. Now that offers investors an enormous amount of choice. And so that's where, as I mentioned at the top of the call, research is really important. Knowing how to identify the sectors or companies that you want to explore is really relevant. Equally, liquidity is very, very important too. We often see people look for very, very small companies, micro caps, potentially, which offer a huge potential return on investment. But you've got to be sure there's liquidity there. And I think a lot of other markets have very low liquidity relative to the US. That's something to consider. We now have 24-hour trading in America, which makes a difference for people globally as well. So a lot of smaller international markets don't necessarily have that liquidity or that access. And of course, one of the major benefits of the US is that a lot of international companies do trade on the US through ADRs, or obviously getting access through index funds, etc., things that can give you access to international markets. Not just US companies, but buying international companies on the US can often be sensible just in terms of liquidity and the ability to trade those investments freely. So, we do recommend diversification in terms of the markets and geography. It's important to consider other countries and their relative position in the global economy. Don't have everything in the US, for example, but just consider what is out there. But certainly, as I mentioned, liquidity and access is a very important part of investing. Being able to realize your gains. It's one thing having paper gains, but if nobody's there to buy what you're trying to sell, that can be very difficult and frustrating on smaller markets.
Sage answers, yeah, thanks. Okay, we're going to go to the Q&A box now to sort of have a look there, and maybe Kevin will be able to re-signal whatever in a minute. What would your investing advice be for a young student?
A young student, that's a really, really good question. So the first thing is investing from a young age is a really good idea. I've observed it. I'm 45. I didn't really start investing until I was about 25. And when I look back, anyone who has the discipline to have some excess cash, even a small amount on a monthly or annual basis, and putting it into an investment portfolio is something to be strongly recommended. The impact of time on compounding is a very, very powerful thing in investing. The value of money over time is really, really, really important. So the earlier you begin, the better. You'll also learn to make some mistakes and manage your money carefully, because money means an awful lot when you have less of it. And you have to be careful about how you invest. And so I think investing as a student is a really good idea, because it gives you the opportunity to learn. And again, back to why we think our platform is one of the best ones to use. It's because that information, the educational resources are there, the research is there, the support is there to talk with a professional about what you may want to do, both in terms of risk management and investment choices. So my advice to any young student is exactly that. Absorb as much educational resource as you can, consider your future, have a plan, and try and stick to it. I've recommended to so many people over the years, Russell, discipline is a really important part of investing. And the sooner in your life that you can get to that point where you can be disciplined in your decision making and your investments, being able to put money aside every month, no matter how small, it's a really, really important part of achieving a successful financial plan.
Yeah, and I think with, zero commission and fractional size shares, you can always get in now, which wasn't
Yeah,
always the case.
fractional shares makes such a difference. I mean, we recognized that particularly with some of the very popular stocks that were, if we look at Amazon or Google, where the share price was just going so high that they needed to, effectively be made available as fractional shares to investors. It's made a real difference, particularly to younger investors, like presumably the person who asked that question.
Okay, so next one down, and I have to admit that, so I'm going to ask you, what are the key differences between investing here or with an AI like Smavesto? I don't know Smavesto, so I'm going to just say, assuming you do.
I'm actually not familiar with it, I'm afraid. But
Okay, fine. So
what
let's,
yeah.
I don't know. So if the questionnaire wants to give a bit more detail, but let's go on to the next one then. Yeah. Do you foresee there being any pitfalls or probable mistakes people are likely to make with the market as it is? Oh, and Kevin's back here. Yeah. So welcome back, Kev. Sorry.
You gotta love tech. I got kicked out, but I'm back in. Sorry
Just
about that.
careful with the tech stocks. Do you want to take this question then? So, do you foresee there being any pitfalls or probable mistakes people are likely to make with the market as it is?
Well, I think a common pitfall, especially when we get into such a concentrated market, and I don't know if this was forgive me if this was addressed while I was trying to get back in, but we're now at a point, at least for the U.S. You've got, if you just took the Mag 7, the Magnificent Seven, inclusive of Nvidia, Apple, Microsoft, et cetera, they're slightly more than 33% of the S&P 500's market cap. If you extend that to the 10 largest stocks in the S&P 500, you're looking at 40% of market cap. So just by, even if you're not investing in those stocks individually, if you're going into any products that track the S&P on a cap weighted basis, you're going to be more exposed to a slimmer and slimmer number of those companies. So by definition and mathematically, you're going to be swayed more, and your portfolio is going to be swayed more by just that handful of names. So, not really doing any adjustments to your portfolio and letting that happen over time, you get, again, mathematically, you get more concentrated over time. So I think that maybe a pitfall, or maybe I don't want to call it a mistake, but I think something that can kind of slip and happen over time if you don't necessarily watch it as carefully, is you could find yourself looking quite concentrated like the market is. So it's not necessarily a bad thing. I mean, clearly that's been quite a strong strategy in terms of returns over the past several years. But I think that at times when you get to that really heavy concentration, and sometimes you get a deeper pullback in some of those names, it can exacerbate a pullback for the broader S&P 500. So as a way to hedge or think about, hedging and diversifying against some of that risk, these are the kinds of moments I think that it makes sense to revisit what your portfolio looks like and how much you're matching up with the S&P 500 itself to see how much concentration risk you do have.
Perfect. Yep, cool. So next up, question. I'm really keen about how the UK market and the economy is treating these tariffs imposed. What's the future of this? I'm not sure whether, do you want to, one of you have a go at that?
I mean, in terms of I can just hit broadly on policy, and then Richard, since you're there, maybe you can actually give an on the ground experience. But I mean, in terms of the deals that have been put together, maybe I'll call them more agreements, because that's really what they are at this point. Just what the UK has agreed to based on the US. I mean, we're still waiting for a lot of formal writing for this to be put into place. There are some aspects of some tariffs that have actually been implemented by the US, in particular, the ones imposed under the president's emergency authority here, that last week were actually deemed illegal by one of the courts. It's going to probably make its way up to the Supreme Court, so it's going to be several months until that's ruled and ultimately decided on. But as of now, we still don't have these formal, inked out agreements between not just the US and the UK, but every other basically every other trading partner that we have, or at least the major ones where there have been these negotiations. But yeah, I think that from a practicality standpoint, and whether it's feasible long term, that remains a question that will be, I think, unanswered for a while in terms of what the UK is willing to accept in terms of how much we're taxing what's coming in from the UK. But maybe I'll turn it to Richard for a more in-depth experience actually.
Yeah, well, I mean, the main thing with the UK is that we are here in London primarily a service economy. Over 70% of the UK economy is service related. We're not, as Kevin pointed to, in terms of the US, we're no longer a manufacturing economy, and as a result, the tariffs won't impact the UK as much as they will other countries that are exporting far more goods to the US. And so if you look at the sectors that are going to be hit in the UK, it's relatively small number. You're talking about automobiles, talking about aluminium. So apologies to our US colleagues for pronouncing that correctly. And Scotch whiskey, for example, things like that. So it's not an enormous hit to the UK, and still the UK seems to have negotiated pretty well with a US administration which seems to be on relatively favorable terms compared to other countries. A big part of this is looking at the comparative performance, comparative advantage. Something that Liz Ann always says, who's Kevin's boss, Liz Ann Saunders, Charles Schwab's chief investment strategist, is that quite often it's important to look at what's better or worse rather than good or bad. And I think, the whole tariff imbroglio that we're going through in 2025, you have to consider, okay, does the news that is coming out, does that make things better or worse in the context of your decision making? And so, looking at the UK as an alternative or looking at other potential countries, where does this leave those countries? What opportunities are there for them? How is it going to make a country like Vietnam, for example, in comparison to its colleagues in Southeast Asia? Look at the comparative outcome of some of these decisions. And the UK, I think, comparatively is in a relatively good space, both in terms of its relationship with the US and the impact of tariffs on really a service-led economy.
By the way, listeners, please can you upvote the questions you're interested in getting answered? Yeah, someone put that on the chat. So one of the questions that was upvoted, what are some of the themes that are most popular with investors today? Maybe Kevin, I guess this is you.
Yeah, I would say, I mean, a lot of it dominates in terms of tech and everything AI related. I would add also, I think and I think this is a positive thing, despite some of the concerns around, budget deficits and how much national debt in the US has continued to grow. The fact that this is not just a US problem, but this is a global problem. But, a lot of interest in fixed income in particular, and how many more strategies are available there now, just because yields have come up so much over the past several years. And really, if you compare them to where they were, right during the pandemic, of course, when the Fed cut to zero and global central banks were cutting aggressively, but also even pre-pandemic. A lot of the sort of mantra around, at least in the United States, post-financial crisis up until the pandemic, was TINA, which stood for there is no alternative, and then you add on to equities. So it was really just the stock market being the only game in town when it came to returns and relatively strong returns for an asset class. But I would add that fixed income, I mean, we're pretty constructive on it in general, not necessarily incredibly long duration, but if you stay sort of intermediate term, there are a lot of opportunities in fixed income. And I even say that as the stock market guy, here at Schwab. So I think that has become certainly a theme and questions that have come up a lot in the events and the client events that I've spoken at, and the clients I've spoken to. But I think in particular for younger investors who either haven't been in the market that long, or only knew a time that post-financial crisis era when yields were really low. I do think that it makes sense to sort of reassess and see what makes sense from a fixed income standpoint in a portfolio, because a lot of that yield, that coupon that you get from yields being as high as they are, that adds significantly to your total return over time and acts as sort of that ballast in a portfolio. So again, what makes sense for an investor, of course, that's going to be the primary thing to think through. But I think that different asset classes and diversification across asset classes makes a lot of sense to approach right now.
And just to add to that, Russell, I might try and answer a few of the questions that I've seen, which are relating to asset allocation and what the pie chart should look like. I remember learning many years ago advice, which I feel is very important, where you should typically have your percentage of low risk or lower risk investments that corresponds to your age. So someone very kindly referenced my age, which is 45. So realistically, what I should have is around 55% exposure to stocks, and then 45% with fixed income or low risk assets. Someone also asks about crypto and real estate, etc. Yeah, again, there's a place for diversification in every investment. Crypto is a speculative investment. Bear that in mind. So broadly speaking, modern investment theory should say that if you allocate roughly the percentage of your age to fixed income, that should provide you sufficient risk management. Again, the role of fixed income is to reduce overall risk in your portfolio. Everybody wants to get great returns, but realistically, if depending on the nature of your goals, if you're looking to invest in the long term, it makes sense to consider how old you are and then use that as a starting point for what percentage of fixed income investments you should have.
That's great. Yeah, no, thanks. I'll do one more question. I'll sneak one more in. There's quite a few been upvoted. Yeah. Which sectors do you think will be the next market winners? Kevin, do you or Richard, have you got any views on that?
Well, as I mentioned, we're still market performing or market neutral across sectors. I will say though, I think if you're looking to, what has been sort of in leadership positioning so far, or what has been in a leadership position so far this year, or really post, April 8th close for the S&P, there really hasn't been any let up from financials and parts of consumer discretionary, and even parts of industrials, which it may sound strange because of all of the trade turmoil we've been in this year and how much of an impact that might have for the economy. But if you take the market's message, which is that breadth and participation continues to look relatively strong for those areas. It's not the only three, but for those areas that tend to be more tied to the economy and more cyclical in nature. Those have been just as strong, if not stronger at times, than the mega cap oriented sectors like tech or comm services. So I would keep that in mind in terms of tech not being the only game in town. It's not always the best performing sector. It may be, the largest and carries a lot of weight for the overall index, but I would be just as attentive, if not more, to some of those other sectors that have shown, pretty solid leadership potential so far this year, but even moving forward.
Excellent. Thank you. Thanks. Sorry, that's all we've got time for today. So thanks very much to Kevin and Richard. And please, as you leave the event today, there'll be a pop-up survey will appear on your screen. If you could just take a few minutes to let us know what topics you're interested in hearing about at future events. Thanks for joining us, and I look forward to seeing you in the future. And thank you for joining. You can join us for free at our MIS Summit in December. There's a link in the chat. Please have a look. Thanks everyone.
Thanks, everyone.
Thanks all.